Okay, so our webinar for today is an introduction to Forex. So the most basic webinar. We have a first introduction into Forex. If you are very new to this industry and to this game we like to play here, then this webinar is for you. So let's take a quick look at what we're going to be dealing with today. So we're going to take a quick look at the history of Forex, the market structure, types of brokers, currency pairs, and then we're going to focus on some of the terminology and some of the things we need to know, such as spread, what is a lot, what is a pip, and how to execute a position in the different kinds of ways. So starting off with a bit of Forex history. How did this modern floating currencies come to be? Well, it all started in 1944 in Bretton Woods, New Hampshire, when 44 of the world's leading nations created a new international monetary system. Now, they decided to tie their currencies to the dollar convertible into gold at $35 an ounce. This became known as the Bretton Woods system. So, in other words, all currencies were fixed in value. Now, central banks would buy and sell their country's currency in order to stabilize it within the 1% of the pegged level to gold or to the dollar. Now, when did all that change? In 1971, the United States abandoned the fixed value of the dollar and allowed it to float. What does float mean? It means that then it's allowed to fluctuate against other currencies. Or in other words, its value is determined by the demand and supply for the currency. Now, by 1973, all other nations participating in Bretton Woods Conference had agreed to also allow exchange rates to float, which leads us into today, where most currencies are freely floating and the price is determined purely by the forces of demand and supply for each currency. So, what is Forex? Well, Forex is the name given to the place where these currencies are exchanged. Forex, in its full name, the foreign exchange market, is the digital place, let's say, where currencies are traded for one another, where you exchange your dollars for euros or your yen for sterlings. But before we get into the more technicalities of the currency pairs, let's speak a little bit about this market, the currency market as a whole. Now, estimates of the market daily turnover. What's the market daily turnover? It's the amount of contracts or value that changes hands on any given day. Now, latest estimates in 2011, let's say, had the global market turnover at above 5 trillion US dollars per day. What does that mean? That 5 trillion US dollars worth of contracts exchange hands on any given day. That means on any given day, $5 trillion could be passing through this market, which as a market makes it the largest market in the world by volume. Yes, if we were to compare it, for example, to the New York Stock Exchange or another exchange. Yes, Forex market being a global market and containing so many different currencies, and by the volume of 5 trillion a day, is seen as the largest market by transaction volume. Now, what about the geographical distribution? Where do all these transactions take place? Well, most transactions happen in London, with 37% of all foreign exchange transactions going through London. And second is New York with 18%. And then we have some other major cities with smaller percentages like Tokyo, Singapore, Switzerland, and Hong Kong. Now, important thing when dealing with the currency market is the timetable or the schedule of the market sessions. Now, essentially, you see, because Forex is a global market that operates 24 hours a day, Monday to Friday. 24 hours a day, Monday to Friday. So we have the ability, or we're enabled to make transactions at any time when the market is open, from Monday all the way till Friday, 24 hours a day. So while the market is open 24 hours, it is characterized by different sessions according to the region that is open for business at that time. To make another note here, of course, there's many currencies to trade, but you would expect most movements of a currency to happen at the times that that country is also open for business. So you'd expect most of the major moves in the euro, for example, in the euro currency, to happen while Europe is open for business, most often than not. Now, this gives us the different kind of market sessions where the market may also be focusing on those currencies a little bit more. But how does a standard 24 hours go in the world of Forex? Well, if we're using the GMT time, then we could say that a normal day starts off with the London and European Open at around 8 a.m. GMT. So London opens up a little bit later, the European markets open up, and British and European markets continue trading until about 4 GMT. However, before the London and the European session closes, the US stock markets open up at around 1 or 2 GMT. So for a brief couple of hours between, well, around 1, 2 GMT and 4 GMT, we have both the London, the European, and the New York market being open at the same time. What does that mean? It means that there's a lot of transactions going on during those times. Actually, we could probably say that the peak for market transactions is somewhere between where those two sessions overlap, between the European session and the American session, especially with all the major currencies that have to do with the US dollar. Most of the announcements affecting these currencies also happen within this time limit between where the European and the American session overlap. However, then the European and London session ends by 4 or 5 GMT, and the American session keeps on going until around 10 GMT, when New York closes off. Now then, there might be a small break, and very soon, the Sydney session opens up. Australia wakes up, starts conducting business, and shortly after, Japanese session also opens up, and Tokyo starts conducting business until the morning hours where those sessions close off, and then the European and London session opens back up again. So it's a 24-hour market, but as we see, according to which regions are transacting at that time, that's when we'd expect most of the currency movements to happen. But in general, we have three main trading sessions. We have the European session, the American session, and the Asian and Australian session. Yes. Now, after the Asian and Australian one closes, London starts back up again, and we start the cycle all over again. So, most active session, as we spoke about, would probably be the overlapping of the European and the American session, which is kind of the hours that we are now, of course, yes? Now we're approaching, let's say, the closing of the London session. All right, so much about our market sessions. And what about the structure of the market? Why do we need brokers? Well, this is how the market works. We have the interbank market. What is the interbank market? It is the market where the biggest banking organizations transact between them. Now, of course, us as an independent trader, of course, we can't have access to this market because in order to have access to the interbank market, we need very big, very huge volumes. So we are the Forex traders. And on the other side, we have the interbank market. Now, The link between us Forex traders and the interbank market is, of course, our Forex broker, which pulls together all the volume for all their clients. And if they're big enough, they have access to the interbank market. So when we buy a contract of currency, we buy it through our broker, who buys it from the interbank market and then sells it to us. And that's how the structure works. Now, what about market participants? Who participates in this currency market? Well, almost everyone. But let's start with the bigger players. So, we can divide them into 8 distinct categories. So, number one, and primary players, central banks. Yes. Then we have other kind of banks, commercial companies, hedge funds and investment funds, and retail foreign exchange brokers, money transfer and remittance companies, and private investors or traders like you and me. However, what do we know about what else do we have to keep in mind about the Forex market? That any kind of transaction that happens involving 2 different currencies goes through the Forex market. Yes? So in other words, it's not only investors or traders who are active in this market, but let's say you are a European citizen, for example, and want to buy something from the United States of America. Now, in order to buy something in the United States of America, you have to pay in dollars. But being in Europe, you have euros. So in order to obtain dollars, in order to buy something from America, you have to exchange your euros for dollars. Now, where do you exchange that? Through the forex industry. So all kind of foreign exchange transactions go through this forex market. So we're starting to get an understanding of the size of the forex market. But now let's talk about currency pairs. Now, in order to buy a quantity of foreign currency, first we need to sell the equivalent value of our currency. So, in a way, simultaneously we sell currency and we buy another currency. That's how foreign exchange transactions happen. Yes? So that's why the Forex market also always works in pairs. In order to obtain dollars, I need to pay in the form of another currency, whether it's euro, yens, or sterling. Yes? But for this reason, Forex market always works in pairs. So let's take a look at a pair. We're looking here at the euro versus the US dollar, also known as the euro USD. Now, euro USD on your platform will always show up like this, with the euro being first and the USD being second. Now, the currency that comes first is referred to as the base currency, and the currency that comes second is referred to as the quote currency. So, if we see that the euro USD is quoted at a price of 1.35, what does that mean? Well, it means that for 1 euro is equivalent to 1.35 US dollars. So if I want to obtain 1 euro, I have to give in exchange 1.35 US dollars. Yes, everyone clear about how those pairs work? All right, so let's see some of the most interesting currency pairs that we have out there. And one of the groups of currencies that we're going to keep a closer eye on are known as the majors. What are the majors? They are the 7 most traded pairs of currencies in the world, and they are known as the majors. They're the 7 of the largest economies versus the US dollar. So all the majors contain the US dollar as one of the 2 currencies in the pair. So it's the US dollar against 7 of the largest economies in the world. So which are they? It's the European economy, so the euro versus the US dollar, also known as the euro. We have the US dollar against the Japanese yen, also known as the dollar yen. I have the British pound against the US dollar, known as the cable or the sterling, and US dollar against the Swiss franc, known as the Swissy, US dollar against the Canadian dollar, known as the loonie, Australian dollar versus the US dollar, known as the Aussie, and the NZD versus the US dollar, also known as the Kiwi. So these 7 currency pairs are known as the majors. Now, why are we so interested about these majors? Well, they are very liquid. They are the most liquid currency pairs out there. What does liquid mean? It means that there's a lot of transactions going on in this market. Hence, always easy to buy and sell. Very liquid also means that we can buy or sell this currency very close to its actual price, or in other words, there's a small transaction cost or a small spread. We'll get to that in a few slides. But majors are very liquid and they are also less volatile. They are heavily traded with an estimate of 80% of the daily Forex market volume going through these 7 different pairs. And because of the huge volume that is traded through them, they are less susceptible to manipulation. Now, they have tighter spreads, which if you're not sure what that is, spread, we're going to see it in a bit, but effectively is our cost of transaction. So tighter spreads means cheaper transaction cost for the trader. So majors, the ones that we just saw, are the ones that we are going to focus more on, if not focus completely on. So these are the 7 pairs we're essentially looking to trade. Now, what's the next group we have as opposed to the majors? The next group we have are the crosses. So crosses are any of those currencies that we found in the majors, but against each other. So the crosses do not involve the US dollar, but involve those 7 other currencies that we saw pegged against each other. Yes, so any of those 7 pegged against any of those 7 is known as a cross. Most actively traded crosses could be considered the euro versus the Japanese yen, the NZD versus the Japanese yen, the sterling versus the Japanese yen, and the euro against the British pound, euro sterling, or the euro against the Swiss franc, or the Aussie dollar against the Japanese yen. So what about the features of our crosses? Well, they are less liquid, but still liquid enough. Yes, less liquid than our majors, of course. And they're considered more volatile than our majors, which can translate to more risky in some kind of terms. And they could be considered more susceptible to manipulation than our majors, considered riskier because of their sensitivity to sudden political and financial developments. They have wider spreads than our majors. However, still a tight enough spread that we can trade them, even on the short term. Yes? So crosses, also another group that we could focus on. Of course, most important being the majors, then the crosses, and then another pair which you may not be looking to focus on unless you have a strong enough reason are the exotics. Exotics are currency pairs where at least one of the 2 currencies is a currency from an emerging economy. So any currency pair that has one of the currencies being from an emerging economy are known as exotics. Some examples of exotics could be the euro versus the Turkish lira, USD versus the Turkish lira, USD versus the Mexican peso, USD versus the South African rand, USD versus the Singaporean dollar. So exotics, well, they are not very liquid. They are very volatile and more susceptible to manipulation, riskier because of their sensitivity in sudden political and financial developments. And they have usually quite wide spreads, which may be a problem for short-term trading. All right, so those are our exotics. As we said, exotics, any currency pair where one of the two of the currencies is from an emerging economy. So those are our different currency pairs that we have. Now, let's understand a little bit more information that we may need when it comes to trading. So next is, what is a pip? What is a pip? A pip, given by its full name as point in price, is the smallest price change that a given exchange rate can make. It's the smallest price fluctuation the exchange can make. Now, it is usually the fourth decimal point. So, for example, if we have a position on the Euro USD, let's say, the position is opening at 130.58, and the position is closed at 130.73. That is a difference of 50. That's wrong. It's a difference of 15 pips, not 0.00, but 15 pips. So, in other words, if our Euro USD moves from 130.58 to 130.59, that is a fluctuation of 1 pip. So our pip is the fourth decimal point. Now, why do we like to recognize pips? Because this is the way that we're going to be measuring distances in the market, through pips. So pip is the fourth decimal point. Now, in some platforms, as we'll see on our platform, the price is quoted in 5 decimal points. For example, the euro may be 1.30582. Now, our pip remains to be that fourth decimal place. So let's say if we're quoted with 5 decimal points and we see that we have a position that's opening at 135.82 and a position that it's closing at 137.33. Their difference would be 15.1 pips. So again, we're looking at the fourth decimal place. Now, on most of the currency pairs, it will be the fourth decimal place. However, on some other currency pairs, usually the ones that are involving the Japanese yen, for example, are quoted in 2 decimal places and sometimes in 3 decimal places. Now, in these cases, such as the euro yen, where we may see the quote of 110.45, our pip is the movement of the second decimal point. Even in the case that we have 3 decimal points, the movement of the second decimal point is the pip. So, for example, if the euro yen was to move from 110.45 to 110.46, that would be a price movement of 1 pip. Yes, so if we were to switch over to our platform, let's put the euro USD in, for example, and if we try and get a new order here, what are we going to see? We're going to see there are 2 prices, yes? Now, as we see, here we're quoted in 5 decimal points. You see that 5-1 being a little bit smaller. Again, if the euro was to move from 1773 to 1774, that would be a difference of 1 pip. So, now that we know what a pip is, what is spread? Well, spread is, as we said, our transaction cost when opening or closing a position, yes? Now, currency pairs are quoted in bid and ask prices. The price to buy and the price to sell, yes? The price to sell and the price to buy. Now, bid is the price to sell the base currency, the first of the 2 currencies. Ask is the price to buy the base currency. Now, the difference between these 2 prices is what is known as the spread. So if, for example, we have an ask price for the Euro USD at 130.58 and a bid price of 130.53, The difference between those two prices, which is equal to 5 pips, not 0.005, again, 5 pips, would be the spread. So if we switch over to our platform, we see here we're 1773, 1775. So the difference between those, which is just below 2 pips, is our spread. Of course, there's an easier way of viewing spread. If you come here on the left panel where symbol is, and you right-click on the symbols and make sure spread is enabled, let's disable it and enable it, then on this here, you should be able to see the spread. Now, when we see here Euro USD and we see 17, that is referring to 1.7 pips, the same way we saw it here, yes? From 1773 to 1775, just below those 2 pips. Now, an easy way, as we said, is to see it there. Of course, what we're seeing here is quoted in points, essentially. Points is that fifth decimal point. Yes, so in other words, 17 points is equal to 1.7 pips. So we see here that the spread for the Euro USD is 1.7 pips. For USD Yen, it's 1.7. For Sterling USD, it's 2.4. So easy way there to be able to see the spread. All right. So just to clear up another thing about spread, of course, another way you'll be able to see spread, as we see on my platform here, we see a gray line which is showing us the bid price, yes? Now what I can do is right-click on the chart, go to Properties, and go to Common here and enable Show Ask Line. Now once I've enabled that, let's go down to a low time frame so we can see this. We see apart from the gray line, which is the bid price, we also see a red line for the ask price. Now the space between those two, which as we can see is the 1.7 pips, is our spread. So what does that mean? If we were to take a position here, let's just show this to get an idea. So let's say we're about to take a position on the Euro USD. Where do we pay this transaction cost? So as we saw the difference between the sell price and the buy price, yes? Now, if I press buy, what do we see? I bought one lot of Euro USD and I see my position was already in negative, yes? Now, the amount that my position is negative as soon as I open it is the spread, and that's where we pay it. So essentially, as soon as we open up the position, we're opening up the position where that red line is, but essentially we're using the gray line. Yes? So as soon as the position is opened, the amount that we are negative is the spread, and that's where we pay this transaction cost. So it's paid essentially when we open up the position, and that's it. All right, so let's get rid of this position. All right, so that is the spread. So the next thing is, what is a lot? Now, you see, currencies are exchanged in contracts. Now, these contracts, in the way that we buy and we sell currency, are known as lots. So lot, or the amount of lots, refers to how big our position size is. So look at this. Now, of course, we're going to describe this based on standard lots. We'll explain this later on if it's needed, but when you open up an account, you have the option to open up a standard account or a micro account, let's say. The difference is referring to the lot sizes. So in a standard account, we're dealing with standard lot sizes. Now, a standard lot is equal to 100,000 units of the base currency. Yes? So, if I was to buy, for example, let's say the Euro USD, and I want to buy a position of one lot, that means I'm buying a position worth 100,000 units of the base currency being the first of the two. So if I buy one standard lot of Euro USD, I'm buying a position equivalent of 100,000 euros. If I buy one lot of sterling USD, I'm buying a position equivalent to 100,000 sterlings. And if I buy one lot of USD yen, I am buying a position equivalent of $100,000. Now, where do we input this setting? Well, here when we come to buy, trading new order, if you see up here it says volume. That volume is the amount of lots that we like to purchase. So if I put 1 there, it is implying one standard lot, or in other words, 100,000 units of euro. Yes? Now, of course, 100,000 units is the size of the lot, but don't misunderstand that. We can buy any amount of lots we want, whether it's 0.01, 0.02, so it doesn't have to be round lots. Yes? So for example, if I input 1 here, I'm buying 100,000 units of Euro USD. Yes? If I wanted to buy only 10,000 units of Euro USD, what would I do? I would put a position size of 0.10 lots. Yes? All right. Now, as we said, there are different accounts for the different account sizes. If you open up a standard account, then on the platform where we put 1.00 here, it implies one standard lot. If on the other hand you open a micro account up, when you come here to trade and you put here 1.00, it is implying one micro lot, or in other words, 1,000 units instead of 100,000 units. Yes? So in other words, one micro lot is equal to 100 standard lots. Yes? All right, so lots is the way we choose our position size, how much we want to invest on a certain position. And now that we know what a lot is and what a pip is, we have to join them together and find the value of a pip. So let's say we open the position. According to the size of that position, the value of the pip will be different. Yes? So how much is one pip worth per 100,000 units of base currency per one lot? Simple formula is the amount of base currency times the amount of pips equals to value in the quote currency. So in other words, what's the value of one pip of the Euro USD if we were to purchase one standard lot? So putting the numbers into the formula, one lot is equal to 100,000 units of Euro times one pip, which is fourth decimal point, as we said, 0.0001, which is equal to 10 US dollars. So earlier, when we purchased a Euro USD position, yes, every time the market moved up in our favor 1 pip, that would be a difference of 10 US dollars on our profit and loss. So what about if 10 US dollars is too much for 1 pip for my account size, and I want to buy less, as we saw earlier? Yes, if I purchase 0.1 standard lots, then the value of each pip would be equal to 1 US dollars. Yes? So this is where, by choosing the amount of lots, by choosing the position size, we're also choosing our risk exposure on this trade, the amount of position that we're investing. All right, so value of 1 pip on the sterling USD, same way as we did earlier. One lot, 100,000 units of sterling, times 1 pip, 0.0001 equals 10 US dollars. What about in the case of USD CHF? Well, again, we buy one lot, 100,000 units of dollar, times 1 pip, 0.001 equals to 1 pip on one lot is equal to 10 Swiss francs. And if we were to buy one standard lot of euro yen, 100,000 units of euro times 1 pip, which, as we know on the euro yen, it's the second decimal point. So 100,000 units times 0.01 is equal to 1 yen, 1,000 yen. Of course, if you're having difficulties with calculating the pip value, then all you'd have to do is go to the XM webpage, go to Research and Education, and here, where it says Forex Calculators, gives you different kind of tools which can make it easy to find the value of the pip according to your position size. All right, so since we know the pip value calculation now, let us understand something important. What is leverage? What is this thing called leverage? Is it the eighth wonder of the world? What is it? Well, leverage, well, this is one way we could describe it. Leverage can be seen sort of as a loan that is provided to an investor by the broker. Although I don't like the word loan because it gives a slight misunderstanding as to what it is, but let's take a look at this. When you open up an account, you have the option of choosing your maximum leverage. Maximum leverage can take the format of 10 to 1, 20 to 1, 50 to 1, even up to 500 to 1. Now, that setting that we choose at the beginning when we open our account is, of course, the maximum leverage that account will be allowed. But what is leverage? Let's see an example to understand better how a trader uses leverage. Let's say we deposit $10,000 in a trading account. And we want to trade with a leverage, a maximum leverage of 100 to 1. What does that mean? If we've got $10,000 in our account and we're trading with a maximum leverage of 100 to 1, 100 to 1 leverage is implying that we can buy a position up to 100 times the value of our starting capital. Now let's see how that's done. So we have our $10,000 times 100, which is our maximum leverage, 100 to 1. That gives us a position size of 1 million US dollars. So that means now that we can buy or sell a position up to $1 million. In other words, the leverage provides the means to an investor to have increased trading capital, giving him the opportunity to have a maximized outcome, of course, both on the profit and the loss side. So in other words, leverage gives the ability to the trader to magnify his trading results, whether on the winning or on the losing side. So let's see an example of how that can work. So first example, we've got 10,000 in an account. We've chosen an 100 to 1 leverage. That means that we are able to trade with 100 times the money we have in our account. Now, as we saw, 100 times 10,000 is 1 million. So if we were to buy a long position on the Euro USD, using the full position we have available to us. So let's say we open a position at 130.55 and we close that position at 131.55. We made a profit of 100 pips. Now, what is the value of those 100 pips? Well, value of those 100 pips, as we saw, 1 million, which is our position size, times 100 pips, 0.01, equal to $10,000. So in other words, we almost doubled our money, yes, by making 100 pips. So how does that work? Well, if we didn't take any leverage and we bought a position of 10,000 and the market went up 1%, what would be our profit? 1% on our position, yes? But if the market goes up 1% and we've traded a position 100 times our original value, then that 1% is translated to almost 100% of profit. So what is it enabling us to do? To magnify the results of our trading. Now, in this case, of course, that we made 100 pips profit, we almost doubled our money. But what about the other case? So again, we have a trading capital of €10,000, and our maximum leverage of 100 to 1. Again, we choose to open a position at 130.55. This time we close the position at a loss at 130.35. Now, how much did we lose? We lost 20 pips. 20 pips times that position size is equal to $2,000. In other words, we lost almost 20% of our money because we used very high leverage, of course, yes? So what does leverage enable us? It enables us to magnify our trading results, both on the winnings and the losses. Of course, abusing leverage can easily get a trader into trouble because, of course, it increases risks, yes? That, of course, when using very high leverage. On the other hand, leverage enables us to trade with a larger capital than is available in our account. So, of course, it is an important tool that a trader can use. Yes, of course, how a trader uses leverage is up to him of when he chooses his position sizes. Yes. All right. Of course, we'll have some time at the end for any kind of questions or anything that's not understood about these things. We're almost getting there. But what is margin? Well, margin is sort of the other side of the coin as far as leverage. Now, since a trader is allowed to use more capital than the amount he has deposited in the account due to leverage, a collateral or a margin is required in order to open up a position. So we need a margin or a collateral in order to cover any losses. So let's see this to help understand it. Let's say our initial deposit is $20,000 and our leverage choice is 20 to 1. That means we can open up a maximum of 20 times the money in our account. Yes? Now, if we're allowed a maximum leverage of 20 to 1, that means the opposite ratio is that the required margin in order to open up this position is 5%. In other words, in order to open up a position, since we've got a maximum leverage of 20 to 1, we have to give as collateral the 1/20th of that position. Or in other words, the 5% of that position is required as margin. So $20,000 that we have times 20, the maximum leverage we're using, that gives us a position size of $400,000. So what's 5% of, before we do that, we've got $400,000. So if we buy 2 lots at 1.30, that gives us 200,000 times 1.30 is equal to a position size of $260,000. 5% of that 260,000, which is the amount we have to give as collateral, is equal to the $13,000 margin. So in other words, out of our 20,000 that we have in our account, 13,000 are now being used as margin to hold this position open, and that allows us another 7,000 from our account that can be used to open up new positions. And that is what margin is. So, what are long and short positions? Well, in Forex, a trader makes profit when his sell price is higher than his buy price. Yes? We sell something more expensive than we buy it at. That's how we make a profit. Now, the order in which we do that does not matter in Forex. What do we mean by that? That someone could make a profit by, let's say we've got the Euro USD, trader is expecting it to go up, so he goes long. Long implies he is buying the base currency. So he buys first at 1.30, and then when the market goes up to 1.3050, he sells that position, or in other words, he closes that position, and he's made a profit of 50 pips. Now, same thing can be done in the opposite order. Let's say we've got the Euro USD and our trader is expecting the market price to fall, but he doesn't have a position. So what does he do? He sells first, or in other words, he goes short, which means to sell the base currency. So he goes short at 130.50. Then when the market drops down to 130, he buys back that position, or in other words, closes that position and makes a profit of 50 pips. So in other words, in the Forex market, we can buy first and sell later in order to make our profit, or we can sell first and close that position later and make a profit if we're expecting the market price to fall. And that is that's how a profit is made in the Forex market. Yes, by our sell price being higher than our buy price. Now, which we do first? Both are available for us. All right, so that's all we had today for an introduction to Forex and a look at some of that terminology. So let's see if there's any questions regarding what we saw today. Any questions about the material that we saw? Anything that is not understood about what we saw? Or any further information about that? All right, so people are asking if they received the webinar notes for today's webinar. Yes, you will be receiving the webinar notes in the email provided by you when registering for this webinar. So you will get those webinar notes automatically. All right. I see another question. How do I know if it's the right time to buy or sell? Well, to get an answer to that question, you're going to have to go through this 20 module webinar series, which will shed some light on different kind of techniques on when the right time to buy is, when the right time to exit is. Yes. So over the next couple of weeks, we're going to be looking at quite a few different techniques and building our understanding on technical analysis so you can make your own educated trading decisions. What indicators can we use? You can use any indicators. Of course, many indicators available on the MT4 and MT5 platforms. Yes. Yes, anyone can register on the webinars that we have been talking about. All you have to do is go to the XM webpage, go to Research and Education, Forex Webinars. And here you will find the English webinars. You go to Schedule. All right, and in here are all the upcoming events for the foreseeable future. So as you see, a little bit later on, we're going to be starting the fundamental analyst approach. Then tomorrow, we've got another 2 webinars. So every day, we're going through 2 webinars. This is a 20 module series. So we're going to be starting today, and over this week and the next week, we will finish. And then on the 4th of June, we will be starting again from the beginning with the webinar we just did today. So you can go there. Of course, you have to manually register for each one. Which video tutorial is everyone referring to? Is there any indicator that can show a future trend? Mm-hmm. Who's this guy? Micro account can be opened with any deposit. I think, of course, more information about that kind of stuff and account opening and details about accounts, you should probably speak to support at XM, which are more appropriate to answer any account opening questions. Well, if you're in the webinar, then you should get the notes. So as long as you attended and joined the webinar, then you get added to the email list to get sent the webinar notes. People asking for more information about me. Webinar recordings will not be available, no. All right. Anything else? If you keep the trade on for a long period, will it affect equity? Well, equity is affected as the live profit and loss of that trade is changing. Yes, equity is including all the effects of all the live positions. So equity is affected when we have an open position. Yes. Leverage does not have to do with how much money you have in your account. Yes. I'm Mario for those asking. Does the amount of leverage change your profit loss if you use the same amount of lots? No. We choose our leverage when we're choosing the lot size. When we open an account at the beginning and we choose the maximum leverage, that's the maximum leverage the account will be allowed to take. But how leveraged we are we control it when we take our position sizes. Yes. Just to clear that up, some people that might not be too sure, but let's say I put 1.00 here. Whether my leverage is maximum 100 or maximum 200, it doesn't make a difference. I'm still going to buy one standard lot. Now, depending how much money I have in my account, I will be leveraged so much. But when we open the account and we choose the leverage, that's the maximum leverage allowed. So it's got nothing to do with how leveraged our actual position is. Margin, as we said, is the opposite of trading, so of leverage. So as we said earlier, if I open up a position and I need 5% margin in order to open that position, it means 5% of that position size, of the value of that position, will be held as collateral, meaning that that amount used in margin I cannot use to open new accounts, to open new positions. So here we see my free margin. Yes, that free margin is the amount I'm allowed to use in order to buy new positions. Let's see, if I buy one standard lot, for example, you see my free margin has gone lower. The difference between the margin that's been taken away is what is needed to keep this position open. What is the safest leverage? To answer that completely literally, the safest would be no leverage. Can one change the leverage after opening the account? Yes, somewhere in the members area, probably can do that. The maximum leverage allowed on the account. I'm having a problem determining the value of pips when placing a stop loss or take profit. Well, very simple. Let me show you a quick trick, and this is all we're going to have time for. But let's say I want to sell here. I want to put my stop loss up there, and I want to buy so many lots, and I want to make sure how much am I going to lose if I hit stop loss. Here's an easy way to do it. I was going to sell here, put my stop loss there, yes? Another way we'd do it would be what? Place a buy order up there with a stop loss here where I'm thinking of entering. So let's say I put a stop loss at 1.1767. Now, of course, I put the opposite position of what I wanted to do, but just to show you a thing here. Given that I've put the correct position size, all I have to do now, I have to take my mouse where the stop loss is, and I can see there what the profit will be if I hit my stop loss. So according to the position size I've taken in my stop loss in pips, I can see there the profit will be minus 569 euros. So in this way, I can check if the position size I'm taking, I'm risking the correct amount that I want to be risking. Now, of course, what I did was give the same stop loss as if we would have taken a short, just to see what the value of those amount of pips are based on that lot size. All right, everyone. So that's all we've had for this session. So thank you for joining. Thank you for your questions. And we're going to be back up in about 15 minutes to discuss the fundamental analyst approach. So go have a break. Go have some nicotine. Go to the bathroom. And in 15 minutes, we'll be back to start with the fundamental analyst approach. All right, everyone. Okay. See you in a bit, maybe. All right. Ciao, ciao from me. Bye-bye.